Hey, what's going on everyone? Today's video topic is going to be looking at what is a stock, looking at the different kinds of stocks, why do companies offer stocks, and what kind of stocks would be best for you and your style of trading. The reason a company may offer stocks is because it's an easier way to generate say available capital for the company to grow and develop that it may use to purchase new equipment, hire staff, or create more warehouses for the company's development. So say for example there is a car manufacturing company that's worth $100,000 currently, and it requires another $100,000 to kind of develop and grow its business. So what it will do is offer stocks that people can purchase. And for example, if there was 10 investors and they all invested $10,000 into the company, this would give that car company the $100,000 that it requires. So as the value of the company increases, say over 5 years, it goes from $100,000 to $1 million, all the people who invested that $10,000 will also reap that reward. So their initial $10,000 investment will go up to $100,000. So that's kind of the balance between the investment opportunity it provides for people and the potential profit they can make, and then also the benefit for the business by offering this investment opportunity to people. So when you buy a stock, you essentially become a part business owner within that company. So for example, if you bought $1,000, so if you invested $1,000 into Apple, you would become a part owner, albeit a small amount, but you would be involved in ownership of that business. Now, the same way that the price of a stock can go up and provide a financial benefit for the investors, the price of a stock can also go down, and this will reduce the sort of financial benefit that it has and can cause the investors to lose money. So there are also different types of stocks. The two that we're going to cover in this video are penny stocks and blue chip stocks. So starting off with blue chip companies, these are quite sort of large, well-recognized branded companies. So think things like McDonald's, Coca-Cola, Disney. They're quite often sort of the leaders within their sector. Blue chip investments are often considered to be somewhat safer. They've sort of stood the test of time and have made it through more volatile market conditions. Now, they definitely are not sort of immune to fluctuations at what a stock graph looks like for a blue chip company. We just got McDonald's here, so you can see the quite consistent rise in stock price over time, and also the price of these kinds of stocks is much higher than say a penny stock. So it's at $190 currently for McDonald's, and as we discussed later in the video, penny stocks are sort of $5 or less. It shouldn't be sort of misconstrued or have the idea that just because you invest within a sort of large branded blue chip company that this will be a good investment. There's a lot of other factors that come into play when selecting what stocks you should purchase, and I will be making future videos kind of delving into that a bit further. But just as a disclaimer, one shouldn't sort of like think just because it's a blue chip company it will be a good investment. There's a lot more that sort of factors into those kind of decisions and what stocks you purchase. Sort of another characteristic of these types of companies or this type of stock is their inclusion within large index funds. So looking at the Dow Jones or the S&P 500. For those of you that are unaware sort of what these are, essentially say for the S&P 500, this tracks the sort of top 500 companies within the US, and to sort of make it on sort of that top 500 list, quite often the company does have to fall within that blue chip category to kind of compete with the thousands or tens of thousands of other companies that are sort of around that are sort of competing for a spot within that index. Moving on to penny stocks, these are sort of smaller companies with a market value of sort of $300 million or below. They typically have a cheaper stock price of anywhere just from a few cents up to $5, and they are subject to sort of more volatile fluctuations within their stock price. So for example, the price of a penny stock might go from 30 cents all the way up to $3 within just a couple of months. So a tenfold increase within this price of the stock. But at the same time, how it can quickly, jump up in value, it can also drop at the same rate. The stock graph for Lightpath Technologies, which is a type of penny stock. So just to kind of illustrate the point of how quickly the price of the stock can change in a short span of time, you can see sort of around like the end of January, it's about 63, 65 cents or so. And then as you go up in June, so just about a few months ahead, it goes all the way up to $3.40. So essentially over quadruple the price of the stock. So if you put $1,000 in there, you would have gotten over $4,000 back from that return. But in the same sense, if you look at it over a 5-year period, you can see how how much it can change. You can go all the way up from that $3.75, $4 mark in November, and then all the way down to 67 cents sort of the middle of January. So penny stocks are quite often not held for a long period of time, for this kind of reason. It's definitely not something that you look at, with a 5-year period. You think of it sort of in, say, a few months or a couple of weeks when you're investing with these type of companies. And, looking at another one, Sears, how much it can change in a year, and especially looking at it in 5 years, thinking to yourself, you bought it at $17 in August 2016, and then, by the end of 2019, it's down to, 41 cents. So that would be a terrible investment to make, and that's kind of the risk you make with these stocks. So, at no point did it ever exceed sort of the initial investment you made. It just consistently dropped until it was worth nothing. With penny stocks, they can be in sort of less established sort of sectors, things that can be more obscure, like the mining of precious metals or the development of new pharmaceutical medication. So for that reason, a stock can go sort of completely bust once it's offered by the company, sort of going back to the initial reason why companies offer stocks, to raise capital. But at the same time, if the product or the service that the penny stock is related to doesn't work out, or doesn't gain enough capital, or the trial for the drug is cancelled, or there's side effects found, the whole price or value of the stock can plummet exponentially. So there's sort of a balance with the risk reward for these types of stocks. You kind of have to reach a conclusion on whether the financial risk associated with these type of companies is worth it for you, or whether you kind of want a more consistent type of return, potentially with looking at blue chip type companies. So that wraps it up for the video. I hope you found the content useful, and if you found it helpful, feel free to subscribe to the channel. There will be plenty future stock related and investing content coming soon.